We all know a landlord, whether they're a friend, family member, or you're a tenant. Landlords on occasion are seen in a negative light for various reasons, but like anything, you only ever hear the bad stories. You can be a good landlord and also be a successful one at the same time. So if you're thinking of buying an investment property to rent out, I'll go through the basics of buying a buy-to-let, as well as a few things to take into consideration. So grab a tea or coffee and let's talk. Hi, if we haven't met before, my name's Dan and I'm a CeMAP qualified mortgage and protection advisor. Before I get started, I must stress some mortgages on investment properties are regulated by the FCA. And this video is just purely based on mortgages that are not regulated by the FCA. Please seek professional advice before applying for a buy-to-let mortgage, as there are different types of buy-to-let mortgages and rules surrounding them. Anyway, let's go through some of the basics first. How do buy-to-let mortgages work? The vast majority of buy-to-let mortgages are provided on an interest-only basis. This means that for each month of the mortgage term, you'll only pay the interest on the loan and none of the capital. Therefore, the mortgage balance isn't reducing. This can be good news in the short term, as you'll be able to minimise your monthly outgoings. But it is vital that you have a plan in place to either pay off the full loan or refinance at the end of your mortgage term. How much deposit do you need for a buy-to-let mortgage? To get a mortgage on an investment property, you'll typically need a deposit of at least 25% of the value of the property you're buying. As with standard residential mortgages, the bigger the deposit you put down, the better the rate you'll be able to get. The best buy-to-let deals are usually available to investors with deposits of 40% or more. Affordability rules for landlords. There are plenty of enticing mortgages out there for landlords, but you'll need to prepare yourself for strict affordability tests. In recent years, the regulatory bodies that oversee the industry have imposed tighter lending restrictions on buy-to-let mortgages. As part of their affordability assessments, lenders use the interest cover ratios, also known as ICRs, to calculate how much profit a landlord is likely to make. An ICR is a ratio to which a property's rental income must cover the mortgage payment, tested at an interest rate that is typically 5.5%. Lenders are required to stress test at 125%, meaning the projected rental income must be at least 125% of the landlord's mortgage payments. However, many impose higher levels of around 145%, especially for higher rate taxpayers. When assessing your affordability, lenders will usually work from the rental income that the property will achieve, although you often have to have a minimum income to cover rental voids, should the tenant stop paying. If you have low income, there are lenders available, but just be aware that you may end up borrowing at a higher rate as you're classed as being riskier. There can be even tighter restrictions for portfolio landlords. A portfolio landlord is usually someone who owns 4 or more mortgage properties, but some lenders will even class you as a portfolio landlord if these are mortgage free. So just keep an eye out for that if or when you ever get to this many investment properties. How to compare buy-to-let mortgages. When comparing buy-to-let mortgages, it is important to assess the overall cost of the mortgages, as a cheap initial rate can sometimes be outweighed by high fees. Upfront fees on buy-to-let mortgages tend to be significantly higher than those on standard residential deals. So don't just pick the lowest interest rate, it's not that simple, or work with a qualified mortgage advisor like myself. So, should you have interest only or repayment mortgage? Whether you opt for interest only or capital repayment entirely depends on your strategy and what you plan to do in the future. Whilst interest only is cheaper on a monthly basis, over the mortgage term it's highly likely to cost you more than capital repayment. This is because the balance isn't reducing, so you're always paying interest on the full amount you originally borrowed. Having said that, I recently watched a presentation by a mortgage lender who said statistically the vast majority of the time you're better having the lender's money tied up in the property than you are your own. This is a decision you will need to make. Just remember, if you opt for interest only initially or vice versa, when you come to remortgage, once the initial rate is up, you can switch strategies. Or if you were on an interest only and decided this was the wrong decision, you can often or not make up to 10% overpayments on the mortgage. So you can reduce the balance this way. So give this some serious thought. So let's talk about some downsides to owning an investment property. Buy-to-lets can be stressful and time consuming. Being a buy-to-let landlord means you will likely have to apply for a buy-to-let mortgage to purchase the property, respond to calls about trivial things which you'd usually sort yourself, and deal with the occasional nightmare tenant. Investing in buy-to-let can carry significant risks and is only suitable for people who have a financial cushion to soak up the unforeseen costs. It can be nerve-wracking and take up a lot of time. For some people, it's simply the wrong kind of investment. There is arguably much simpler investments to have than property. On the other hand, there is still money to be made in buy-to-let, and it can be more of a stable investment compared to the likes of stocks and shares market. That's just my opinion and not financial advice. The tax rules can be complicated. Back in April 2016, the government implemented a 3% stamp duty surcharge on second homes and buy-to-let properties in England, Wales and Northern Ireland. At the time of recording, landlords have to pay stamp duty on the whole purchase price, and this is tiered. So if you buy a rental property worth $300,000, the stamp duty works out to be £14,000, compared to a first-time buyer who pays zero. In Scotland, second home owners and buy-to-let landlords have to pay an extra 4% in stamp duty. Buy-to-let investors have also been hit with more tax changes such as income tax, capital gains tax and mortgage interest relief tax. This can start to become very complicated. So if you're looking at investing in property, get an accountant and a tax advisor. I'm not a qualified tax advisor, but I've noticed a lot of my clients who are 40% taxpayers or above are starting to create limited companies to buy investment properties in, as there can be tax advantages. So keep that in mind. I will link to a video at the end to provide more information on this. Not all properties are profitable. In order to obtain a buy-to-let mortgage, you need to demonstrate that it will be a profitable investment. Opinions vary greatly on how to calculate a property yield, such as calculating profit without deducting stamp duty or mortgage interest. Some landlords do, some don't. There are online rental yield calculators to help you with this. Mortgage fees can be steep. I mentioned this earlier, but I want to highlight it again. Some of the fees and interest rates for buy-to-let mortgages can be higher than for a standard residential mortgage, so don't be shocked. I think I've covered the main things to consider when buying an investment property. So let's move on. Age. Not that long ago, it was difficult to get a mortgage in your 50s. However, lenders have been busy raising the age limit in face of buy-to-let demand from buyers in their 60s and above. While lenders normally have upper age limits either for the age at application or age at the end of the mortgage term, these are higher than you might imagine. Some lenders will accept your application as long as you apply before your 71st birthday. Specialist lenders tend to be more flexible than some of the big banks and building societies. There are 10 or so lenders that have no limit at all, meaning you can potentially borrow at any age. So it's never too late to be a landlord. Know the area. Something which could well be a common mistake is not getting to know the area you're buying in. It might be tempting to snap up a bargain 2-bed flat in an area not local to you, but be careful. Not being familiar with the area can lead to serious losses. The demand for rentals in an area could be weak or falling, and the ban on most letting fees for tenants may mean estate agents have hiked up their prices to cover their costs. Should you decide to sell the property, you may find yourself taking a hit. So do your research. Rushing to buy in an area you don't know to try and make money from a property investment may not be a wise move. Also, consider the type of tenants in the area. Is there likely to be a demand from young professionals, young families or students? That will also dictate the type of buy-to-let property you'll purchase. There is a wealth of information on the internet which will help you with this. In preparation for this video, I carried out some research to make sure I hadn't missed anything obvious. I came across a very helpful guide from Barclays Bank, which I will leave in the description below. Please ask any questions in the comments below, and if you've bought a property after seeing this video, I'd love to hear about it. Watch this video on limited company buy-to-lets to find out whether or not this might be something that you could benefit from. Please remember, as a mortgage is secured against your property, it could be repossessed if you do not keep up with the mortgage repayments. Thank you very much for watching, and I'll see you next week.